All righty, guys. All right. Well, we've prepared this presentation. We did this presentation actually a couple of weeks ago at our in-person meetup here in Houston. And we figured this was just a timely topic to kind of talk about what multifamily investors can expect for 2022. And before we get into that, what I'd like to do is formally introduce ourselves at Blue Oak Capital, and here's some of the topics that we'll kind of run through tonight here. But again, Blue Oak Capital, we are a Houston-based private equity firm focused on the acquisition of cash flow producing assets across really Central Texas, but really, we're kind of broadening our horizons across the U.S. We're currently partnered in a deal in Columbus, Ohio, and whatnot. So we're looking to go, where opportunities make sense. Our big mission is just helping investors earn passive income by investing in commercial real estate, and so we're very passionate about that. Represented here is our third partner, Mr. John Beatty, who could not be with us tonight, but he's here with us in spirit. And this is the Blue Oak team here between John, Brian, and myself. So here's a snapshot of our portfolio. We had a really strong year in 2021. We partnered as general partners in $105 million worth of multifamily real estate across 787 units. That was 3 different assets. One here in Houston, one right outside the DFW area, and then a portfolio deal in Columbus, Ohio. You can see some of those pictures there on your right-hand side. We placed a little over $2.3 million in private equity last year across 2 506C offerings, a 506B offering, and we added up to 2,400 investors to our database last year. So a lot of great relationships formed there. Again, I referenced earlier the opportunity that we have currently working on now. This is Hollister Oak Apartments. This is an A-class boutique opportunity here in Houston, 2017 vintage, open to accredited investors. So if, like Gene, if there is anybody interested in investing here in Texas and particularly Houston, we'd love to speak with you about that offering as well. And with that, we're going to go ahead and jump into our topic for this evening. And so what I'd like to do is really kind of set the framework for, what are some realistic scenarios that we can expect in 2022. And by doing that, what I want us to do is go back and look at some of the circumstances that have been implicated because of the COVID pandemic and thereafter. So, and the first thing I want to take a look at is our Fed rates. And when we started going through the COVID pandemic and we started going into, just universal quarantine, essentially everything shut down, correct? I mean, everybody knows the economy basically pumped the brakes and put everything on hold. And so having come out of the Great Recession and seeing the need for quantitative easing, the Fed jumped in immediately and started pumping trillions of dollars into the market to make sure that we do not go into a massive or extreme recession. And so beginning in early 2020, June of 2020, all the way through December 2021, we saw a massive amount of quantitative easing being injected. And so the Fed started purchasing up to $120 billion in bonds and mortgage-backed securities each month up until here at the end of 2021. And what ended up happening because of that massive injection of money printing, the Fed balance sheet really just massively expanded to over $8 trillion, and it's even higher than that now. And in addition to that, the Fed dropped their Fed rates to 0. And the 10-year dropped below 100 basis points. The entire Treasury curve actually dropped below 100 basis points for the first time in history. And I'll show you that graph here in a minute. But we needed that liquidity injection. We needed that money put into the ecosystem. That way we can ensure that the economy doesn't go into a full-on, like I said, recession. And so the market just was flushed with all of this cash, trillions of dollars that needed to go somewhere, right? And then you couple that with fiscal policy. The government stepped in, started providing financial aid and stimulus to business owners, homeowners, renters, property owners, and families with children to make sure that people had enough income or sustainability to continue to keep their lights on or put food on their table. We saw PPP loans for business owners, so that way they can continue to cover their expenses. We saw the implication of eviction moratoriums, where people were not being allowed to be evicted from their apartment homes. And so, all of these circumstances started really creating an environment of, just this massive amount of liquidity that's now just sitting there, needing to be deployed. And so, Brian, thoughts?
Yeah, this is a really important topic to understand what the government did compared to 2008. Cody, I don't know if you were on the Marcus and Millichap presentation earlier this afternoon at 3:30, but they had some economists on there, and they provided some really. I'm going to share the. I'm going to steal the screen share from you real quick. Take a look at this chart that was on this presentation I was on earlier. This is the difference between the 2008 economic financial crisis and the health crisis, which is essentially the recession that we just went through due to the COVID pandemic. Look at the difference in the amount of money pumped into the market in 2008 versus 2020. This gap here is tremendous. So this goes to show you exactly what Cody was saying. The government basically said, we're not going to let this happen again. So you can see they instantly, as soon as the recession started in, call it March, April of 2020, in the health crisis, which is this gray line here, they immediately started injecting money into the markets, which has had the effect that we've all seen here and today.
Absolutely. All right, I'm gonna steal this back from you, Brian. If I can get it back. There we go. All right, so, and that leads us right into the next graph here. Again, as I mentioned to you earlier, for the first time in history, we saw the entire Treasury curve, which is the 5-year, 10-year, and 30-year, all go below 100 basis points. And so, this was the Fed's immediate response into making sure that we're on a lifeboat, so to speak, and it was the appropriate response. I mean, we saw the impact in the very slow recovery after the great financial crisis of 2008, and so it was the right action, but it was a very aggressive action. And so that leads us right into our next point, which is the effect on the capital markets, our banking system. And so, we saw this creation of a historically low interest rate environment, and the commercial mortgage-backed securities were essentially wiped out, and that used to be the gold standard for lending for commercial real estate, back before we had the agency debts, your Fannie, Freddie loans and such. So, but basically the remaining CMBS loans were just completely wiped out. That market's gone. We saw this resurgence of floating rate debt. We saw a massive spread between your floating and fixed rate debt by over 100 basis points. And so what that means is you had, investors, especially experienced investors, getting floating rate debt below 300 basis points, some even in the mid 200s, 250 basis point range versus your fixed rate debt, that was around, we've seen it around 300 to 350 basis points at its lowest peak. And so, in addition to that, we also saw lower rate cap costs. And so there's been some volatility as far as the rate cap costs go, but for the period of time there, very, very affordable and cheap to get those rate cap costs. So guys or investors were able to get in just at extremely, extremely low interest rates, which made their ability to become more competitive, more opportunistic. And so we saw this resurgence of bridge debt. I call it the rise of the bridge lender. About 85% of last year's acquisitional volume was executed on bridge debt, and particularly with floating bridge. And there was just so much volume because of that. With bridge, your competitive advantage over your agency is, you had more flexibility, you had higher leverage, you had the ability to finance your CapEx costs, and you didn't have the long-term hefty defeasance or prepayment penalties that you get with the agencies. And so we just saw this massive wave of bridge executions because you could then again become more competitive. So with that increase in transactional volume, we saw the highest recorded transactional volume in Q3 of 2021 ever recorded in commercial real estate. And you also saw this massive increase in institutional capital coming into the affordable housing space. Your guys like BlackRock and Greystone, injecting $5 billion plus into the affordable housing space and really starting to compete in markets that historically they may have not been in prior to, or investing in assets that they normally wouldn't, chase after particularly. And again, that's because of that massive amount of liquidity that they had that needed to be deployed and needed to be placed in something secure. So, and then also because of the impact that we've seen on office, retail, different commercial centers, that negative impact forced other capital to come into the multifamily space from those asset types. And so, again, just exponentially increasing the amount of competition that we've been seeing in the space. Brian, any added thoughts there?
Yeah, I mean, this is why we have such a hard time finding deals right now, because interest rates are, or it's not the only reason, but it's definitely one of the reasons. We've heard this from lots of experienced operators. So they're basically giving out free money right now. We've got inflation at 7+%, which is what they're saying it is. I think we all know it's actually higher than that. And we've got interest rates, and there was a point there, Cody. We know some people that got sub 3% on some, getting sub 3% loans on $20 million when inflation is 7, 8, 9, 10%. There's a huge delta there. So this historically low interest rates, I don't know if we'll ever see it go that low again. But this has definitely caused a lot of fierce competition, which we will continue to talk about in the presentation.
Absolutely. All right. One other key factor that's really been setting the stage for 2022 is the supply and demand imbalance. And, we're in this age of a historically low inventory, and, we're currently at about a 35-year low of supply of single family homes. And that was recorded as of October of last year. And, really the housing deficit, this bullet point here is reflective of 2020, but actually, I think to date, we're over 5 million homes that are needed to meet that demand. And so, the housing crisis, or the housing shortage, really has started decades ago. I mean, you can look at the graphs across multiple different resources, and you can see the decline and development due to various reasons over the past several decades. But really, after the Great Recession, we saw a really massive dip and pause of development. And with that, it's really put us in this significant housing crunch. And you can see here from 2018 to 2020, the housing deficit increased by over 50% alone within that time span. So just a significant amount of supply imbalance there. You have high increasing development costs, between labor shortages, rises in supply costs, material costs. You have supply chain interruptions that have been a big factor. And, just the development pipeline is not able to keep up with the pace of demand. And then you're also seeing a massive demographic shift. And so we now have this massive transfer of wealth from the baby boomer generation to the millennial generation, which is now the largest demographic in the United States at over 72 million in population. And that's your ages that are 25 to 40 years old. And, this is the first time home buyer, right? These are your renters by either necessity or by preference. And so, this massive amount of new demand coming from this new demographic is putting an even increased pressure on that housing supply. And then because of that, we're now seeing this rapid acceleration of asset valuation or asset value inflation, We're seeing accelerated rises in home prices index. We're seeing a massive amount of absorption across all of the country. For the first time ever, we're seeing record low vacancies at close to 4% across the United States. And then you're also seeing rises in rents, double-digit rent growth last year recorded across most of your major markets last year. So just a really, really high demand that's really creating this interesting dynamic for multifamily right now in particular. Brian, thoughts?
No, I think you hit the nail on the head. Perfect, Cody. Low inventory is definitely playing a large part in this. And again, that call to keep referencing on, I was on earlier with Marcus and Melchap. They have even further projections for vacancy rates, especially by asset class. and they expect them to continue to go down. They have a forecasted projection of a number in the twos by the end of this year. So I think we're going to continue to see a supply and demand imbalance. There's a lot of permits out there, but there's still a lot of buildings that are needed. So we definitely are in a good space in real estate.
Absolutely. Absolutely. Now, this graph here reflects just what we were speaking to, right? The asset value inflation. And you can see here, this is the graph going back to the early 1960s of the median sales price for homes across the United States. And I want to really just draw your attention here to the far right-hand side here. Look at starting in 2020, the rapid acceleration of the median home price here, which is now over 400,000 in the United States. And if you think about that demographic shift, right, the millennial generation, who's now your first-time home buyers, they're getting priced out of the market. It's very hard for a first-time home buyer to come into a position where they can afford a mortgage on a $400,000 home. So this is really taking a very big impact. And again, it's forcing a lot of what would be potential home buyers to become renters in today's time. And so looking at the 2022 impact, then there's a few other factors that we need to bring up here. And what we're seeing now, Brian, you mentioned this a second ago, right? We're seeing the inflationary pressure. We're now seeing inflation at 7%. I think, Brian, you mentioned again, we all know it's much, much higher than that. The Fed has announced that they're going to tighten up their monetary policy and accelerate the tapering. And the FOMC meeting was just yesterday. They're moving from a very accommodative position into a very aggressive position, meaning that tapering is going to be done call it March, and then we should expect our first rate hike in March of 2022. And I think if I'm correct, they also announced that we should project at least 4 rate hikes in 2022. And so for one, I'll be honest with you, I was one that was screaming inflation was transitory. Once the supply chain interruptions resolve, that inflation would cool down. I think that has taken a little bit longer than expected. Even though it's getting better, there are still some supply chain interruptions that are being dealt with. And so I think you're also seeing a lot of political influence here now. Our current administration is not doing so well in the political eye or the public eye as far as handling inflation. And so I think there's some political pressure here for the Fed to respond more aggressively to the current environment. And so, it's just an interesting dynamic that we're seeing as far as the inflationary pressure. Labor force participation, for the first time, we started to see unemployment rates fall below 4% at the end of 2021, which is reaching near pre-pandemic levels. Depending on what resources you look at and what variables are considered, if you look at the adjusted unemployment rate, it's still roughly around 6% or so. But nonetheless, we're definitely moving very aggressively towards filling in the labor force participation. And because of that, you're seeing wage inflation. And Brian, I know this is a pain that you feel all too well at your coffee shops. You want to speak to that?
Yeah, absolutely, Cody. We're seeing rising prices across the board, right? So we're seeing not only rising costs in things like food costs, but we're also seeing a rise in costs in things like labor. And I know that's something we hear in all spaces, real estate, construction, it doesn't matter what space you're in. So yes, the unemployment levels they're showing that they're better, but as Cody highlighted, there's still a massive amount of workers needed, and particularly for jobs in the retail hospitality space that work at a lot of the places that we visit on a daily basis. I mean, how many times do you go up to a place that you love to visit and there's a now hiring sign? It's almost everywhere you go, right? So even though the numbers might be showing that unemployment is, quote, better or pre-pandemic levels, I think we all know that there's still a massive gap of workers out there. So,
yep, absolutely. To couple with that, we're also seeing, this massive migration patterns. Our friends over in California, New York, are seeing a rapid shift or momentous shift, from the East and West Coast into Sunbelt states, the Southeast states. And that's partly due probably because of maybe some of the local politics, maybe some of the local legislation there that makes it hard to operate businesses like multifamily. You're also seeing the impact from virtual working, virtual workspaces or workforces. Now having the luxury to be able to work from the convenience of your home, that allows many people to move to where they want to move. And so you're seeing this massive shift into, again, the Sun Belt, the Southeastern United States. And then you're also seeing a shift out of your urban cores into more of your suburban living, because again, the virtual workspace, you don't have to commute in and out of, busy urban cores and deal with traffic. You can just work from home. So now the demand is shifting towards more of your suburban living. And one last factor I think is very, very important is the tax implications. When the current administration was coming into office, the big question mark was the 1031 exchange and if that was going to get scratched from our current legislation. And you saw this, I don't want to call it a panic, but you saw this massive response from people looking to execute their 1031 exchanges to avoid that implication. And so we saw a lot of competition from 1031 exchanges this past year. And then if anybody doesn't know this, this is the last year for 100% bonus depreciation on our cost tech studies. And so I think we're seeing a lot of responses from people trying to really benefit from, again, this 100% bonus depreciation as well, before it starts to taper after this year. So taking all of those factors into account and taking in all of the impacts that we see both during and after the pandemic, what scenarios could possibly play out for us as multifamily owners in 2022? And here's a list of a few that we think are very realistic scenarios. And we've already kind of addressed some of these, right? A rise in interest rates is almost inevitable. And I think that the Fed is in a very, very peculiar position where they have to do something to combat the inflation that we're seeing right now. It's impacting our workforce housing demographic. It's impacting our blue and young white collar workers. And so, there's just this increased political pressure to just combat what we're seeing in the inflation. And so I think rise in rates are going to be inevitable. Now, the question is how aggressive will they be this year and what impact will that have on the markets? And that's going to be interesting to see how that plays out this year, because if they become too aggressive, it actually could put us right back into a downward spiral and actually get moving towards the direction of a recession. And then we start this vicious cycle all over again. So
yeah, and that's something we forgot to mention on the previous slide, right, Cody, is the Feds, they're kind of handcuffed, right? Mm-hmm. If they don't do anything and inflation continues to rise, then people are upset. If they raise rates too fast and it knocks us into a recession, people are upset. So they're definitely walking a really tight rope with the rates.
Yeah, I don't want JP's position right now. I don't want to have to make those decisions. He's got a big undertaking. So I think that you're going to still continue to see increased demand and competition. Again, there is still a ton of liquidity that's out in the marketplace, looking for security, looking for a recession resilient asset class like multifamily to protect their interests and protect their liquidity. And so I think that you're going to continue to see the very, very high competition and demand that we've been seeing, which is only going to further fuel asset value inflation. We've seen this rapid appreciation in asset values across all real estate, but specifically multifamily. It's been incredible just to see assets that are, 12 months ago are now valued, 30, 40% higher 12 months later than what they were previously. And that's a product of or byproduct of demand. And so we're seeing that. I think you're going to still continue to see cap rate compression. And this is a subject that I think is a interesting debate, depending on which groups that you talk to. I think a lot of people believe that a rise in interest rates will force cap rate expansion or contraction. And, if you look at historical data, there is some correlation, but it is not a direct one-to-one correlation. And so, the cap rate compression that we're seeing now, again, is that byproduct of the demand for the asset class. So I think it's a very realistic scenario that as rates continue to rise, you're still going to see cap rate compression because of the amount of competition and the amount of liquidity chasing multifamily. Brian, you want to speak on that too?
Absolutely. Who doesn't want to buy multifamily right now? Right. So I feel like everybody we talk to is either coming from another asset class, like single family, or they're just figuring out how attractive multifamily is. And that's because everybody realized how resistant it was during both recessions. Obviously, prices were a little different back in 2008, 2009. But at the same time, we've seen a couple of market corrections in the last 10 years, and multifamily was resistant during both. So we've talked about how much liquidity is in the market and how money is sort of chasing I hate to say it's chasing yield, because we're seeing yield shrinking in the multifamily space, but it's looking for a safe home. It's looking for a place to park itself so that it can weather the potential storm that's coming, particularly in things that we've seen this week. What's happened in the last few days in the stock market? What's happened in the last few days in the crypto market? People realize how volatile these markets are. And when times are good, Cody, how many people do we talk to that are like, hey, man, you should be thinking about protecting your wealth? And they're like, have you seen the stock market? It's like, I like to call those people back sometimes. So stock market's a great investment vehicle. You just it's one of those things that you just have to, hedge against your bets and be careful with your risk exposure. But real estate's a great way to diversify, and people are realizing that. So we're seeing more liquidity, and it's pushing cap rates down. We're seeing more demand. It's a great time to be in real estate. But it's going to be interesting to see if the rates continue to go down.
Well, it is a great time to be in real estate, Brian, and in commercial real estate in particular. But to your point, with the increased demand and that we're seeing in the way that asset value inflation continues to rise, you mentioned this, right? Yields are getting tighter and tighter. The days of 8 to 10% cash on cash are very, very hard to find nowadays, unless you're going into some very rural tertiary markets or whatnot. It's yields are very, very tough to come by now. And so investor expectations have to change and understand that this is entering an age of becoming a new normal. Some people may have said that in the past, and some people may not agree with that, but the reality is we're moving more from a cash flow type of asset into more of an appreciation type of asset across most of your desirable markets that you really want to be invested in. And because of that, you're seeing this massive shift in flight to quality. Historically, over the past decade or so, the value add play was the golden child of multifamily and syndication, particularly, right? You could go buy the distressed asset, do some renovations, some CapEx injection, reposition the asset back to market rate, and everybody's happy. Well, the unfortunate thing is about the timing in the market now is if you're in a rising interest rate environment, you take the chance of not being able to refinance a multifamily property at the timing that you need, and that could impact your ability to execute your business plan. You take the fact that you have properties that are 60s, 70s, or call it early 80s product that has been bought and traded hand over hand multiple times over the past decade, and everybody's just slapping lipstick on the pig, but not fixing the underlying infrastructure. But yet you're still seeing that value continue to increase. Well, eventually somebody's going to get caught with that asset that's going to have a complete infrastructure breakdown, busted pipes, fires, what you name it. And so you got to be very, very careful right now moving into this, this interesting market cycle and with the way that we're seeing asset values go. And so that's why you're seeing this massive shift to quality, right? So people are wanting the security of having a newer building with less CapEx requirement, less deferred maintenance requirements and such. And taking all of that into account, and with the amount of liquidity coming in the market, I think the barrier to entry in multifamily is the highest it's ever been. I mean, it was always a higher barrier to entry anyway, especially when you compare it to single family. But now more so than ever, we're competing against big capital. Let's be honest. Again, we mentioned the institutional buyers, for example, deploying $5 billion into the affordable housing space. You're now seeing a tremendous amount of competition in a space that normally we would not see. And so the barrier to entry is very high. And so for anybody on the call tonight that's new, and you're hearing that and you're maybe scratching your head like, oh man, don't get alarmed by that. It is what it is, but it doesn't mean that it's not, it's not something that can't be overcome. And it all starts with just what we were mentioned earlier, relying on your network, partnering with the right people, pulling together resources to continue to break down a lot of those barriers. And that's how we remain competitive. And so, Brian, any last thoughts there?
No, I agree with Cody. We're not trying to discourage anybody, but the barriers to entry is high right now. So doing what everybody's doing now, talking to the right people. There's a cheesy saying, we're full of them. It's not how, it's who. Right. So if you are having a problem, building your network is the best way to overcome that barrier to entry.
Yep. Absolutely. Absolutely. Well, I want to stop right there before we go into our contact page, Brian. I want to see, I haven't looked at the chat box. What do you guys think? I'm going to open up to the floor here. Does anybody have any comments or any points that they would like to make in regards to maybe some of the scenarios that we could see in 2022?
I think it's going to be probably the age of partnerships, like really partnering just to compete in a sense. Because, every time I get a article alert, Tide's equity is buying something else, right? and they got plenty of money just to burn in their pocket. So, for people who don't have that amount of capacity, it's really going to be partnerships. I think it's really going to be key, especially going forward, because I don't see anything that's going to really derail the appetite, the huge appetite just for multifamily, just for industrial. And some of that's tailoring off into retail that I've seen, but that's mostly grocery anchored and single tenant net lease deals. So I think this is going to continue. Even if interest rates go up, there's always a lag between what the seller wants and what the buyer wants to pay. And that's going to continue, because they're still going to seem like, hey, we want, what we got last week. Who cares if the interest rate went up, 50 basis points? You know what I mean?
Yeah, I think you're absolutely right, Dominic. I mean, the amount of competition that's out there it's a real challenge. It's a real problem. And if you don't have the right capacity, like you said, or the right resources, you're going to be left sitting on the sideline. And so I think you're absolutely right. I mean, and it's funny, Brian and I, we joke about this all the time, at our networking meetings or whatnot. It's funny how many people are all bidding on the same deals, but nobody's talking to one another. And everybody's bidding deals up, a couple $1 million at a time. And it's one of those things where if we would just continue to work together, you're right, and partner together, we can hopefully, like I said, break through some of those barriers. You're absolutely right.
Mm-hmm.
I would also, to piggyback off that, I also think it's the decade of the asset manager. I think that operational excellence is going to be absolutely key moving forward, because if you're buying at the aggressive valuations that we're seeing now and your margins are so thin,
Mm-hmm.
you don't have a lot of room for error now. And so, the true operator is going to be key throughout this, next several years for sure. So great point, Matt. I appreciate your input there.
Yeah, because you can only cut your expenses so much. Because if you look at some of those, presentations from other people where they're talking about what they're doing on management, right? They're trying to take one less person that's inside out. You know what I mean? But if you look at those assets, sometimes, especially out of those larger Class A's, if you ever walk around, especially in podium styles, and they got a whole bunch of dogs and stuff like that, you got to have somebody still. You can't get rid of that person, because that ruins the experience of the tenant, which affects eventually you leasing, and then affects your cash flow and so forth and so on. Just goes up the chain.
Absolutely, man. Absolutely. You're absolutely right. Great points, man. Great points. Anybody else?
So with all the different aspects that you guys kind of brought up, it makes sense just given the financial condition we're in. Do you basically are asserting that for first time buyers, Class C assets would be really the potential entry point, considering everybody's going to basically upgrade and move into B plus or A, and you'll just end up seeing a lot of properties on the market that are Class C, just built in the 70s, 60s. Is that kind of what the world is going to look like in terms of available supply for somebody who's not syndicating?
That's a good, interesting question. And because I think in our observation, what we've been seeing, it doesn't matter if it's the A space or C class product, everything has been just absolutely flying off the shelf. There's just such a demand for the asset type in general that, we're not seeing any type of hesitancy towards, your C, B, or A class product. And so I think historically, most of your first time multifamily buyers cut their teeth on, your value add C class space, but historically you would have more of a delta between the premium you'd pay for your A class versus your C class, right? When we're not really seeing that delta anymore, you're not seeing that spread. And so I think there's still going to be opportunity in the value add space, but you just have to go in with a much more cautious approach and a much more, I don't want to say, well, I guess I'll say it in this form, conservative approach where you're well capitalized and that you're really making sure that you're doing some thorough due diligence to make sure that your entry is going to be protected against your downside risk. And so we are seeing a lot more of transactional volume coming from the A-class space right now. We're seeing a flood of A-class product hitting the market as of late. And so I think that there probably will be some less competitive opportunities in the C-class space, but I think you could still expect a lot of competition there. So Brian, you got any thoughts on that?
Talking of the Houston C-class space, is there a projected sweet spot per door? Like, would you say that there should be between $65,000 to $70,000, or that something like that doesn't exist, or like
that does not exist? If you find something at if $65,000 to $75,000 a door, I would tell you to run.
Yeah. Yeah. I mean, really, Niraj, I mean,
run from the property or towards it?
Run away. Run away.
There's something egregiously wrong.
That's exactly right. Yeah.
Well, I mean, in El Paso, I mean, they're about 50, 60. That's where you'll see it, but that's a different city. So
that's a tertiary.
That's where you see. Yeah.
Secondary, I would say.
Yeah. And that goes back to the point right now. Like, again, if you're looking at your cap rate spreads, like Houston, for example, since we brought it up, your A-class product, you're buying in a 3.5, call it 3.5, almost four cap, right? Well, your C-class product is trailing right there. Your C-class product is also trading at a sub 4 cap, and that's where you have to be really cautious. That's where you have to be really concerned, because if you're buying on that premium, like Brian was saying, I mean, if you're buying Houston on a C-class product that's 70 a door, there's a lot of hair on that deal, a lot of hair on that deal. And this is a sidebar conversation, but this goes to talk about the importance of knowing your market. A market like Houston, you have to be very careful because we don't have any zoning restrictions within Harris County. It's a market that's street by street when you look at it from the Houston proper MSA. And so you can get into a lot of trouble if you come into a market that you don't understand and really have a good understanding of the topography. And so I would, I'd really encourage you, just take your time, Niraj, and just do some really, really thorough market analysis, especially like a market like Houston. Phone a friend, especially if it's not your backyard, meet with as many industry professionals in that particular market you go into, and just really try to get an understanding of the lay of the land, so to speak, before you make any investments, especially in markets like Houston, man. We see it all the time where people get themselves in a bad situation. So.
Yeah. And I would encourage you, what we see a lot of is, and this is just something to be wary of, is a lot of, and I hope nobody here's a broker. A lot of brokers try to take advantage of out-of-state buyers.
Oh yeah.
Sure. They know that these California buyers would gladly buy a 3.5, a 3.75 cap compared to what they're used to seeing in the market. So they're going to pitch you on a 3.75 cap C-class value add deal, telling you how amazing it is, when you don't realize that it's 60s product. It's got flat roofs. It's got boilers and chillers. It's close to the water. It's $900 a door in insurance. Your property taxes are 90% of your new appraised value. When you start looking at the deal, and when you peel back the onion really far, you realize it's not a deal at all. So just be careful with who you're talking to. I would, like Cody said, phone a friend, and then just realize what he's saying, that there's such, cap rate compression. We're seeing really large C-class properties, 200 plus units, trading at 3.75 cap because it's value add. People are buying it because there's value to add, literally, to speak. So I wouldn't expect to get a discount on a C-class product at any time soon, because people they're still flying off the shelf.
Yep.
Yeah, you're going to pay a premium for anything that's labeled value add. So that's why you're going to see some product from some brokers that are trying to get some of these duds off their books,
Yep.
label it value add, and then they already know, hey, that's a premium because they already told the seller. Sometimes they're just buying listings.
Yep.
That has always confounded me. If it is value add in such clear sense, why haven't you done it? Like,
well, you always want to
Unless-
leave meat on the bone for the next guy. That's a business strategy. You don't do everything, but the brokers, I mean, that's their job. They're selling a story. There's always a value add. You could buy something brand new that has no tenants in it. They'll tell you that's the value add. Add tenants.
Everything gets value add. Yeah, everything gets value add labeled on. But hey, great question, Naresh.
Hey, I want to propose this, Cody and Brian. So what do you think? So, because of the competition, all those dynamics, and, a lot of people that I've listened to say, development's become more interesting, but obviously there's constraints with that. Do you think there's going to be a bigger push in trying to get some of these cities to relax on some of their, impact fees and restrictions to kind of push for more development and to bridge that the shortage of housing? Because we're so far behind. You guys mentioned that before.
Dominic, you need to listen to our podcast in about 2 weeks.
Yeah. We actually just had this conversation earlier with the guy on the podcast. And I think to answer your question, I think they're going to have to, right? I mean, I think your municipalities are really going to have to recognize that we are in such a shortage that if they don't relieve some of those restrictions and they don't make it more opportunistic for developers to come in, that deficit's only going to further. And so, they need to be more flexible, and they need to allow developers to come in and continue to, build out that pipeline. So, every municipality is different. Every local and state government's going to be different. So I think, the louder that we as business owners can be and speak and get in the ear of our politicians making some of those legislation, I think that's going to take the biggest impact. But it's a good question, man. I think it's going to be a tough push, but I think it's going to have to happen. And I think you're seeing some of these policies now, and I'd be interested to get other people's thoughts on this too. But you're seeing legislations like rent control happening across some states and such, and a lot of governments feel like that's a solution to some of the rent inflation that we're seeing. But historical data shows that things like rent control and stuff are actually bad for multifamily. They're bad for the housing markets in the states or local governments where those are instituted. And so that's not the solution. The solution is we need more housing. The rise in rates and the rise in rents are a byproduct of demand and the shortage. And so the only way to fix that is build more housing. And so
build more housing. Yeah.
Build more housing. Yep. So good question though. Great question.
Hey, Cody, I have a question. In talking to brokers and on the B and C class properties, they say that you can't build in today's market. You cannot build a unit for, say, $70,000 a unit. So they always have the replacement cost. What are your thoughts about that?
I'm sorry. Did I hear you say you had brokers tell you that they could replace our product for homes?
Can't, Cody.
They can't. They can't build it. So,
yeah.
Go ahead.
Yeah, I mean, look, the development input costs right now are through the roof. I mean, if you're looking at building any type of sizable multifamily community, you're looking at $200,000 plus a door to erect a multifamily building, and that's across most of your, general United States. And that's a product of, again, material cost inflating, labor shortages that are significant across the entire general contracting community. And again, just the demand, it's all of those different input costs are just really affecting multifamily development. And so now the question becomes can you really buy things on a discount, and when you look at what it costs to buy an existing building now versus what it costs to build one, the brokers will try to pitch you that story, and you'll hear that often, but listen, that can't be the sole variable that you base your thesis on. Just because it doesn't cost the same to buy it as it does to build it doesn't necessarily make it a good opportunity either. So, I think you have to be really careful of that. Now, I think where you might see some of that opportunity is some of your product that may have been your newer product that may have been delivered, let's say in the last 2 or 3, 4 years, maybe, as compared to your new product that's coming online now. That might be some opportunity there because that product is going to continue to appreciate, and that's where your true discount, I believe, you may find. But even that is becoming harder and harder to find. Did that answer your question?
Yes, they'll tell me and say, well, we're at 50, they said that we're at $70,000 per door. You cannot build this unit for $120,000. And so they try to.
Yeah. And that, I mean, look, there's some truth to that. I mean, there is some truth to that, but again, that doesn't always necessarily ring accurate, or not accurate, but it's not apples to apples when you're comparing your C-class product versus your A-class product,
Right.
So
thank you.
Yep.
Can I ask a question about the rent control that you mentioned earlier?
Yeah.
So like how concerning is it as for investors that, do you see this as being more commonplace in the upcoming years, that we're going to have more and more cities implementing this? And despite, we have inflation on the one hand, where expenses are going up, caps on rents increases each year. So, I mean, that could be a pretty dangerous situation, right? Going in that direction.
Yeah, no, it absolutely can. And I think it's a topic that everybody is trying to keep an eye on. I'm sorry, you're going to hear my daughter in the background here. It's definitely something that people are paying attention to. And it is something that you're hearing more and more discussions around, if it's going to become universal across multiple states. But I think that you're going to find a lot of opposition to that too. And I think you're going to find a lot of supporting data that shows that rent control is not your solution to fixing a supply issue. And so I think there's going to be a lot of resistance that may hopefully deter that from being a universal rollout. But if not, if anything, it will slow the rollout for sure until we kind of get a handle on how do we resolve the supply issue. So I guess my thesis is I don't believe that we're going to see a universal rollout of rent control. Hang on, baby. Okay, baby. Here, come see. Here, you want to come say hey to Daddy's friends? Look. All right.
Yeah.
Go say hi.
Hi.
Hey.
This is the little one that steals the show all the time. So, but I think again, I don't think that it's going to be a universal thing. I think there's going to be enough opposition, enough data to support the resistance against that. And I hope that rings true, because listen, as multifamily owners, if you can't increase your rents to keep up with inflation, for example, what incentive is that going to have you do to inject capital dollars to improve your properties, or, help provide a safe, reliable building to your residents? Although we want to do the right thing, when you have, significant capital that's on the line, or, debt payment that needs to be paid, it could take a big impact on your properties. And so, I think there's going to get a lot of opposition there. So I don't think that's going to be a realistic scenario, but it is a thing that we're all trending and following. So.
Yeah. And I think, Cody, to chime in on that, rent control doesn't always have to, it's always labeled as a bad thing, but it doesn't always have to be. There's some cities that do it successfully. And I think where it can become potentially beneficial to you as a landlord is if the government is incentivizing it, especially in the affordable housing space, where we literally need affordable housing. So, if the government comes in and says it's optional, if you want to put like a LIHTC on your property, if you want to put some sort of government assistance on there saying, hey, if you guys keep your rents down at a certain percentage of what the normal salary is in the area, we'll give you guys a massive tax credit, right? Well, at that point, you start looking at the property very differently than you would if you were just trying to force rents up, right? So, Cody, we've looked at a few properties that have those LIHTC type things in place, but they can be beneficial. But the thing is they only work, those things only work when they're not forced upon you, right? Nobody likes the government coming in and like slapping these rent controls on you. I think there's a way for them, hopefully, to strategically do it and make it a program that you sign up for, where it's like, okay, I have a C-class property, I want to improve it, I want to make it affordable living. Let's offer this as an option for landlords so they can see some sort of benefit long-term, which ideally would be passed down also to your investors.
Yeah, Brian, I think that's a very good point. That'll be a great initiative to help, also hopefully attract developers to come in and try to develop more affordable housing. Right now your development pipeline's filled with your A-class product, your A++ product. You're not seeing a lot of affordable housing really going back to those input costs. It's hard to produce an affordable housing product that can be sustained operationally. And so, that's a great alternative if the municipalities would offer more of those, tax abatements or light tax type things like that. It might incentivize more developers to come in and build that type product. So that's a great point.
And see, because that's kind of my, oh, go ahead.
Well, I was just going to ask, as far as when you then sell that property, certainly the requirements stay in place with the property, but do the tax benefits stay in place with the property?
Yeah, they do. Yeah. So it
Yes.
does get passed down to the new owner, but you still have to operate within the restrictions of that contract. Now, some of the contracts are negotiated to such where you can actually buy out the tax credit contract at a certain point of its life cycle. So let's say at 10 years,
year 15.
Year 15, yeah, you could buy it out and remove it. But it's just something to consider if that makes sense to you or not at the time. But it does get passed into the new owner. Yes.
Yeah, and that's something to be considered of. It makes your exit very different, Gene, because that's not appealing to every end buyer, right? If you're syndicating and you're on a 3-year hold or 5-year hold, and you're only on year 4 of your LIHTC on a 30-year agreement, you can't exit for another 11 years. Maybe the new buyer doesn't want it, right? And they can't do anything about it. So there's a very niche group of buyers. It kind of filters down your market. So it's just something to be considerate of on your exit.
Yeah. So like in that market, because that's what I kind of carve in my niche in. So what you have, and the reason is obviously because you're talking about the input costs and development costs, and then the high competition for that 9% credit. The affordable housing developments are getting smaller and smaller. So just to make the numbers work, you can't build as many units as beforehand. So now kind of the solution has been kind of doing of a mixed income. What I've been trying to do is have discussions with the housing authorities and the PFCs and partnering with them, because what that does is, because they're a government entity, essentially what you do is they'll give you a ground lease. And since you don't have to pay taxes on it, that allows you to run the operations a little bit better. And as long as you offer, 50% or more allocated to 80% of AMI, 60% all the way down to 30%, as far as that. And then for more existing stuff, what I've seen is using the 4% in attachment to the bond capacity, because your bond rates are so low that it makes it more financeable to have lower cost debt. So you're not going to have as much equity on the deal.
A whole another ball game.
Yeah.
Great questions, guys. Great questions. Anybody else have any comments? Any questions? No? Well, all great discussion, guys. All really great questions, great comments. And listen, I think overall, 2022 is going to be a phenomenal year for multifamily. I think there's still going to be a lot of opportunity. I think that you're going to have to be prepared to get uncomfortable to be competitive in this space. But again, that's where the power of community comes in, and the power of network comes in, and banding together, to go achieve your goal. So, definitely don't sit idle. Make sure that you're staying active and being present in the space. Yeah, you tell them, shh. And, just definitely capitalize on this year for sure. So before we get into, I guess, the final piece of networking here, guys, I just wanted to kind of share our contact information with you if I can. If you want to get connected with Brian and I, you can find us here at our multiple different platforms. You can check us out at our website. We have a great podcast that we bring on a lot of high caliber guests to talk about all things related to apartment syndication. So definitely make sure to check out that. If you have not joined our Facebook page already, make sure to join the South Texas Multifamily More Facebook page. And then you can always check us out via email here. If you want to learn how you can partner with us and potentially invest with us, make sure to check us out at blueoakinvest.com/investor forum. And we'd love to learn more about you and your investing thesis. And so, all right, guys, with that, I'm going to open the floor back up here and let's just do some networking, man. Let's just have some fun here.
Cody, you want to stop the recording?
Yep. It's already